This video is about how information passes from one period to the following one. In this video, we'll see permanent and temporary accounts. We also see the distribution of profit or loss from previous period, and also how profit or loss from the previous period is not mixed up with the profit or loss from the current period. The first idea is permanent and temporary accounts. The balances of accounts that passes from one period to another are the balances of permanent accounts, that is, assets, liability, and equity accounts. However, the balances of expenses and revenue accounts, they don't pass from one period to another. Instead, they are summarized and into the profit or loss, which is an equity account, and it passes from one period to another. Let's see this idea through an example, Dublin 2011 and Dublin 2012. In the last journal entry of Dublin 2011, we can see that we have the balances of assets, liability, and equity accounts. And in the opening journal of Dublin 2012, we have the same accounts on the opposite side. That is only equity, liability, and asset account. Number 2, distribution of profit or loss from previous period. In Dublin 2012, in the opening journal, we can see that we have the profit or loss of year 2011. In this particular case, 4,245. If the company decides to keep all in the company, then we record this decision in transaction number 9 by debiting profit or loss from previous year and creating legal reserve and voluntary reserve. If the company decides to keep part of the profit or loss from the previous year and other part distributed through dividends, in this particular case, we credit different types of account: equity accounts, legal reserve and voluntary reserve, and a liability account, which is dividend payable. And then we'll pay the dividends later on. The third aspect I'd like to introduce in this video is that the profit or loss from one year is not mixed up with the profit or loss from another year. Let's take the example of Dublin 2012. We can see in the opening journal that we have profit or loss from year 2011 and is distributed later on during the year. And finally, we determine the profit or loss for year 2012 from the income accounts and expense accounts of this period. At the end of the period, when we balance off this income account and this expense account.